Let's have a session on how should the government finance its spending. So if you're looking to finance your spending, then it's got to happen one of two ways. Way one will be raise taxes, and way two will be to issue gilts. Starting with raising taxes. So if you're to increase your taxes to finance your government spending, then if you're thinking about the circular flow of income, withdrawal and government spending is going to be injection, but if they're equal to each other, well, there's not going to be an increase in AD here, so that might not be a reason to do it. So that could be a disadvantage of doing that route. However, it's worth being aware of the balanced budget multiplier, and that may apply, and that may actually lead to an increase in AD. We'll just go through a simple example of why. So for the balanced budget multiplier, the two key formulas that you need to be aware of is your simple multiplier for the government, which is just the 1 over 1 minus MPC. But also there is a multiplier for taxes, the tax multiplier. And the formula for that is minus MPC divided by 1 minus MPC. Now, if we just imagine that the MPC was 0.9 and that government spending was 10 million in this example, and if we just calculated through chucking in the 0.9 into the multiplier formula, come to 10. And then if we took that number we've calculated, 10 being the multiplier from government spending, and we timesed it by the government spending here of 10 million, then 10 times 10 is 100. So we've got 100 in terms of the overall effect of government spending, including the multiplier. Now, on the other side, if we look at the multiplier for taxes, so if we took here minus 0.9, we just chuck in the MPC, divided by 1 minus 0.9, that comes to minus 9. So the multiplier for taxes is negative 9. Obviously, it's negative because it's going to be a withdrawal. So if we took K for taxes and timesed it by the government spending, which in this example was 10 million, then minus 9 times by 10 is going to come to minus 90. And the key thing here is that there's a net effect. And that net effect is clearly going to be 100 minus 90, which is 10. And it suggests that in this situation where the MPC is 0.9 and you've had 10 million of government spending, that actually AD will increase. AD will increase. And that's a big point. So the balanced budget multiplier is an important evaluation point that you could use here. Also, other things to think about when you're raising taxes is clearly it depends on the specific taxes that are going to be increased. Let's just say you used corporation tax. If corporation tax is going to be increased, well, that's probably going to reduce investment and it's going to put in disincentives for enterprise. If you go down the income tax route, then there's clearly going to be disincentives to work. However, you might want to think about which band is going to be increased. Is it going to be the personal tax allowance, or on the other extreme, is it going to be the additional rate of tax that's affected and that's increased there? Also, you might want to go down the spending taxes, so indirect taxes route. And it could be that you could look to exploit anything that's got inelastic demand, like cigarettes or alcohol. Okay, so that's looking at raising taxes as a way of trying to finance your spending. But now we need to look at issuing gilts being the other likely route. So if you issue gilts, well, clearly that's just debt. And in this case, we're thinking that it's going to clearly increase your UK public sector net debt, which is just your national debt. So issuing gilts is effectively selling bonds to the financial markets. It could be like insurance firms, pension funds, very likely. But the key thing is, if you're selling bonds to the financial markets, that's an increase in supply of gilts. And if you have an increase in supply of something, obviously that's going to lead to a lower price. Now, if we think about the financial market formula, that we must know that yield as a percentage is effectively just a coupon rate divided by the market price all times by 100. Well, if your market price here, as we've calculated because of the supply increase, has gone down, well, if that number there goes down, it's going to lead to your yield increasing. So yields are likely to increase. And because yields are effectively just the effective rate on national debt, well, that's just your risk-free interest rate. And if your risk-free interest rate is increasing, that could lead to interest rates in the market increasing. And that's clearly going to have a point on the terms of like the crowding out of private sector investment, because if you've got higher interest rates, they might not be able to meet their hurdle. So it could lead to investment not being induced into the economy. Also, Also, with higher interest rates in the market, that's a concern when you've got already high levels of household debt. I think in the UK right now it's roughly £15,000 per household, and that's a genuine concern. Also, corporate debt is obviously massive. Many companies are saddled by huge debt burdens. And also we need to be thinking about the fact that with higher interest rates, it's going to mean that the debt burden for future generations is going to be greater. So I hope you enjoyed that, and I'll see you at the next sesh.